A broken small-town bank can still be worth millions because underneath bad loans, weak controls, and shrinking trust, it may still hold deposits, a charter, a building, and a town's habits. That is the strange business logic behind this title. The buyer is not just purchasing a failing balance sheet, but a financial institution whose hidden value may exceed its recent mistakes. There is one honesty note right at the start. A perfectly documented public case matching every part of one man bought a failing small-town bank and made it profitable is surprisingly hard to find. Real rescues are usually messier. They happen through investor groups, bank holding companies, management takeovers, or private deals that never produce a neat before and after story in public. So the clearest way to tell this story is through 3 documented patterns that together show what a real community bank turnaround looks like. First, a true troubled bank rescue under Jill Castilla at Citizens Bank of Edmond in Oklahoma, where the glamorous part came only after the operational disaster was confronted. Second, a clearly priced community bank acquisition at Lead Bank in Missouri, where Jackie Reeses and her investor-backed effort repositioned an old bank into a much more profitable modern platform. Third, a small-town long-game growth case at Carroll Bank and Trust in rural Tennessee, where ownership tied to Billy Carey and Billy Tynes shows what patient rural expansion can achieve. Before those cases, we need the basic problem. Why do small-town banks fail in the first place when they look so simple from the outside? One major reason is concentrated bad loans. A giant national bank can spread risk across regions and sectors, but a community bank may be hit hard by one weak local industry. Commercial real estate, agriculture, construction, or a few oversized local borrowers can drag down the whole institution if underwriting discipline was loose or the local economy turned. The second failure pattern is weak controls. Poor reporting, sloppy oversight, weak underwriting, or outright fraud can make a struggling bank far more dangerous than the raw loan numbers suggest. The third pattern is economic shrinkage in the town itself. If the town loses population, small businesses, payrolls, and local confidence, the bank loses both deposits and good lending opportunities. Competition then adds pressure from 2 directions at once. Larger banks take the strongest customers, while digital lenders skim away fee income and convenience expectations. Funding pressure is another quiet killer. When deposit costs rise faster than loan income, margins get crushed, and a small bank may not have enough scale to absorb the squeeze. Then there is regulation. Compliance costs land on small institutions too, but they are spread across a much smaller asset base than at a national bank. That means a weak community bank does not just need one good quarter, it often needs a full cultural reset before anyone can trust the numbers again. This is why buying a troubled small-town bank is not like buying a cheap shopfront and repainting it. You are buying a place that stores wages, local business liquidity, and civic memory. In a town bank, people know who approved the loan, who denied the loan, who sponsors the school fundraiser, and which branch stayed open after the storm. So when trust breaks, the damage is financial and social at the same time. Deposits can leave one family conversation at a time. That brings us to Citizens Bank of Edmond and Jill Castilla, one of the clearest public examples of what a real troubled bank turnaround looks like before the headlines get flattering. When she arrived in 2009, the bank was not simply underperforming. A terrible examination was underway, and reported issues included fraud, mismanagement, and erroneous financial statements. Castilla herself described it as "a bank in shambles," which is a stronger starting point than most neat business turnaround stories admit. The key lesson from that moment is that there was no glamorous shortcut. The bank could not simply inject fresh capital and declare the problem solved. The first job was operational triage. Clean up internal reporting, restore governance, and rebuild discipline so that management could actually trust what the institution was seeing. That phase sounds boring, but it is the foundation of every serious bank rescue. If the books are unreliable and the culture is loose, growth just adds speed to failure. Only after the bleeding slows can the next layer begin, and at Citizens Bank of Edmond, that meant rebuilding trust inside the bank before, rebuilding ambition outside it. Later, Castilla pushed low-cost technology and product innovation rather than trying to outspend giant competitors on their own terms. That is a key community bank lesson. Small banks do not beat big banks by acting like weaker big banks. They win by combining trust, agility, and focused decisions. The Citizens Bank case does not give us a tidy purchase price and profit. jump in one line, but it gives us something more important: the anatomy of rescue. First, stop the chaos. Second, restore reliable information. Third, change culture. Fourth, use innovation only after the institution is stable enough to deserve growth. Now move to Lead Bank in Missouri, because this case shows the acquisition side much more clearly, including publicly reported deal value and measurable profit improvement. Lead Bank was acquired in 2022 by Jackie Reeses and her investor-backed effort, with the purchase price publicly reported in retellings at roughly $52 to $56 million. This was not a classic failed bank seizure story. It was an old community bank being repositioned aggressively around a different strategy. The value in buying the bank was not only its traditional local operation, it was also the charter, the balance sheet discipline, and the ability to build new revenue around that foundation. The strategy was strikingly modern: keep the bank charter and core community bank logic, but add fintech partnerships and embedded finance services that old local banks rarely had. That matters because plain vanilla community banking can become vulnerable when it relies too heavily on spread lending alone, especially during interest rate and funding pressure. By adding new fee and infrastructure revenue streams, the bank was no longer trying to live entirely on the old formula of deposits in, loans out, margin in the middle. The reported results were real and measurable. In the first 9 months of 2023, Lead Bank posted about $107 million in revenue and about $12 million in net income. 2 years earlier, for the same period, the bank had reportedly produced about $79 million in revenue and $6 million in net income. Total assets reached roughly $951 million, up by more than $100 million year over year, showing that the strategy did more than create a short-term accounting trick. This is one of the clearest public examples of a bought community bank becoming much more profitable through strategy rather than through branch-killing austerity alone. Lead Bank also illustrates a wider buyer mentality. Sometimes a community bank is attractive precisely because the market sees only its old shape, while the buyer sees what the charter can become. That is not always available to every buyer, of course. Fintech partnerships require capability, compliance, and risk control. But the principle still scales down. A bank whose name looks sleepy may still contain distribution, trust, and regulatory permission that would be far harder to build from scratch. Now move from modern repositioning to rural long-game ownership with Carroll Bank and Trust in Tennessee, originating as the Bank of McClemmersville. This case is different again. It is not a dramatic emergency rescue and not a flashy fintech pivot. It is the small-town end of the spectrum done patiently. Ownership shifted when Billy Carey and Billy Tynes acquired the bank in 1972, and the importance of that date is that it frames the story as a multi-decade rural growth play. Recent case study analysis reported total assets growing from about $357 million in 2020 to about $509 million in 2024. Net income rose about 37% over 5 years, and net loans and leases rose nearly 73% over that same period. Those numbers tell a very different kind of success story from Lead Bank, but the underlying logic still fits the theme of making a local bank more valuable than it first appears. The strategic moves included expansion into contiguous counties, investment in staff, a stronger customer-facing presence, and the addition of financial planning capability to boost non-interest income. Notice how all 3 cases point to the same broad lesson. Community banks do not become profitable again by one magic move. They recover through many unglamorous fixes, each aimed at turning sleeping assets back into a functioning engine. So if you wanted to summarize the one who bought the bank formula in plain English, it would sound like this: buy or take over a bank whose name, habits, and charter are worth more than its recent numbers suggest. Fix the credit culture before chasing growth, because bad loans and weak controls can destroy every clever strategic idea that comes later. Protect the trust-building parts of the institution because the teller, relationship, local reputation, and community presence are often the most irreplaceable assets in the whole deal. Then add 1 or 2 revenue lines the old bank never had, instead of trying to turn a rural bank into a giant universal bank overnight. Those steps show up again and again in the most believable turnaround stories, which is why they are worth looking at separately. The first repeat strategy is brutally simple: stop making bad loans. That sounds obvious, but it is the real start of any serious recovery. Tighten underwriting. Review the loan book borrower by borrower. Work out or sell problem credits quickly. Exit concentration risk where possible. especially if too much of the bank's future is tied to one local sector that no longer looks healthy. The measurable payoff is lower future charge-offs, cleaner earnings, and a more workable relationship with regulators who no longer feel management is guessing. The second repeat strategy is to cut dumb costs, not trust-building costs. Community banks cannot win by becoming joyless mini versions of national banks. If you cut every frontline relationship in pursuit of a spreadsheet, you may also cut away deposit stickiness. The smarter cuts are duplication, bad vendors, outdated processes, unused space, and the kinds of expenses that survive mainly because nobody has challenged them for years. The payoff is a better efficiency ratio, faster service, and retention of the customers who still value seeing familiar people at a local branch. The third repeat strategy is to add revenue lines the old bank never had. That can mean treasury services for local businesses, wealth management, financial planning, better small business payments, specialized lending, or digital partnerships if the institution can manage them safely. The point is not to become everything at once. The point is to reduce dependence on plain spread lending and build resilience around the bank's actual strengths. Every time one of these strategies works, it proves the same deeper business principle. A broken small bank is often underperforming, not worthless. Its charter still matters. Its deposit base still matters. Its local brand memory still matters. Its building, borrower files, and customer habits still matter. The buyer's job is not to invent value from nothing. The job is to uncover value buried under bad culture, weak decisions, or strategic stagnation. That buried value is more powerful in a town bank than in a huge national institution because the bank is part of the town's self-image. A giant bank is abstract. A community bank is local history with a vault, and people feel its decline more personally. This is why turnarounds in small banks are part finance and part civic repair. The numbers improve only if confidence improves. And confidence does not return because management gives a speech. It returns quarter after quarter when the bank proves that its mistakes are no longer its identity. At Citizens Bank of Edmond, the story highlights cleanup, governance, and disciplined rebuilding before innovation. At Lead Bank, the story highlights acquisition, strategic repositioning, and measurable profit growth through new business lines. At Carroll Bank and Trust, the story highlights patient county-by-county expansion, staff investment, and stronger non-interest income over time. Different routes, same principle. The institution becomes profitable again when management stops treating the bank as a static object and starts treating it as recoverable infrastructure. That infrastructure includes licenses, systems, customer trust, and community habits that would cost far more to recreate from zero than to repair from weakness. There is also a useful warning for anyone romanticizing the idea. Buying a small bank is not a clean entrepreneurial hack. If the loan book is rotten, the reporting is weak, and local trust is gone, the buyer may inherit years of pain before the turnaround becomes visible. That is why the best operators look for downside first. Can the bad credits be contained? Can the culture be changed? Can the town still support the franchise? If those answers are yes, the upside can be meaningful because the market often undervalues institutions that look tired but still hold durable local importance. And if those answers are no, the bank may be less a bargain than a slow-motion liability dressed up as nostalgia. So the real hero move in this business is rarely buying at the auction-like moment itself. It is knowing what can be fixed and what cannot. The smartest buyers understand that a community bank's value is not found only in this quarter's profit line. It is found in a small business owner's payroll account, a farmer's operating line, a family's mortgage habit, and the branch everyone still trusts after a storm. Repair that well, and profits can return. Repair it badly, and the town quietly moves its money elsewhere. That is why rebuilding a community bank is not like flipping a house. A house does not judge you, a town does. And a town decides trust incrementally through everyday interactions that either confirm stability or revive old doubt. So when you hear a title like Man Who Bought a Failing Small Town Bank and Made It Profitable, picture less of a lone genius and more of a disciplined sequence. Stabilize the books. Fix the credit culture. Cut the waste, not the relationships. Add the right revenue lines. Prove reliability long enough for trust to compound again. Do that, and a struggling local bank can become far more profitable than its recent past suggested. Do it badly, And you are not just losing a deal, you are losing the institution where a town stores its paychecks, business loans, and confidence in tomorrow. If the stories of Jill Castilla, Jackie Reeses, and Carol Bank changed how you see old financial institutions, watch the next business storytelling video on this channel for another case where boring infrastructure hides the real opportunity.